The equity markets have done really well. Everything is at an all-time high. And there's also the time when a lot of normal people do some really weird and abnormal stuff. How do I know that? Because I am a normal everyday investor and I've also made some of the most ludicrous mistakes in the past, which includes selling some of my mutual fund units to directly invest in stocks. I started dabbling in futures and options, and please don't ask me how that went. A sense of FOMO sets in, and we end up chasing performance without considering valuations. Even within valuations, our benchmark seems to automatically go up. And although the Nifty long term P ratio is 21, our brains would suddenly start saying, Chalo yaar, 21 nahi, 24 ke average pe aage badhte hain. What else? There is a complete neglect of risk management strategies. There is reduced diversification. People end up investing in penny stocks, and of course, everyone is super confident of the future. Now, assuming you are not making these mistakes, there's still the question of how one should operate when the markets are at their all-time high, and there are two lines of thought here. The first is the ubiquitous buy and hold approach, and I would count index fund buyers as a part of that crowd who would continue to say, "Chale chalo, chale chalo." And at the other end of the spectrum are traders for whom an in and out strategy is a way of life. Now, if you're in the middle, lump sum investment hai, SIP भी चला रहे हो, stocks में भी कुछ पैसा डाला हुआ है, then I would say do consider booking profits, as it not only helps maximize your gains, but also aids in reducing portfolio risk and also preserving capital. This will get clearer as we go into the profit booking strategies, so let's begin. The first strategy is called all or nothing, and although this is unrelated, this strategy is a bit like my knowledge of poker. That is, when I have no idea what is happening or what might happen, I just say all in and pray to God that things will work the way I want it to. From an investing perspective, there is always that urge to sell off every morsel of equity one holds when the markets are at an all-time high, and to sit on cash, which in my view will be a big mistake. And that's because all said and done, a sizable portion of your wealth creation is going to come from your portfolio's equity allocation, which means even if one sells a bulk of their stock or mutual fund holdings, you still need to redeploy that cash in equities as early as possible. I don't really need to explain this with data, and we've seen it time and again. After a drop in valuations and a corresponding fall in the index, the stock market always tends to rise up. So what's my point? My point is we really don't know when the bounce back happens, which is why it's important to stick to a minimum equity allocation at all times. 50%, 60, 70%, whatever your pre-decided comfort level is, and one should be churning only the opportunity part of the equity portfolio for such tactical calls. For example, in my case, 50% is the lowest I'm ready to go and 70 is the highest I've ever been. So 50 to 70 is my comfort zone. And depending on where the valuations are, I use this difference of 20% on a tactical basis. However, this is not a rule I follow when it comes to sectors, and a drought of policy changes by government, the monsoons, pandemics like COVID, dumping, which is another unwanted gift from the Chinese, a drop in demand, regulations, etc., can have a profound effect on any sector and the companies within it, which is why I don't mind moving out of a particular sector if it's too overvalued, or if there are some issues like what Morgan Stanley seems to be saying about the paint sector. But all said and done, never ever go for an all or nothing strategy when it comes to equities. So which fund to redeem, which stock to let go of is amongst the toughest decision one has to make, and there is no dearth of advice on this. One of the first of many solutions that I have received over the years came from an ex-colleague at ICICI Bank. Saurabh, if you're listening to this, I'm sorry for giving away your technique, but it was Saurabh who taught me this concept of free shares. That is, if your investment has doubled in value, then you should sell half the number of shares, because that means you have not only recuperated your capital, but effectively the shares that remain with you are virtually free of cost for you. Now, I don't know if Saurabh still uses this thumb rule or not, but certainly I don't use it anymore. In fact, I avoid doing anything related to percentage appreciation in stock price, irrespective irrespective of whether the profits are at 20%, 30%, or even 100%. It's an important mindset to have, and I'm sure you, I, and everyone else would have seen many situations where a stock has gone on to double and double and double and double a few more times, with Titan being one of those prominent examples. But it doesn't mean these profit percentage based strategies are wrong. It's just that it might be more suitable for short term traders rather than long term investors. The smarter thing to do, in my opinion, is to pick your sell candidates based on valuation indicators like the P ratio, the PB ratio, etc. And when I look at the top 10 listed cement companies in India, we can see a broad range, with the P ratio going as high as 60, as low as 25, and the bigger players having a multiple in their 40s. If not anything, it gives you a comparison-based logical idea of under and overvaluation, and combining it with other factors like earnings growth, sales growth, future estimates, and even with price-based technical indicators like moving averages and RSI, can give you a better understanding of which stocks can be let go of during market highs. Another way of looking at this price versus valuation conundrum is by examining where the P ratio was when one invested in the company and where that ratio is now when the price has gone up and you're looking to sell it. For example, let's say you bought Apollo tires an year ago when it was available at 312 rupees, and because the stock is now available at 115 rupees, it means you made a profit of 33%. Now you are considering selling the stock because 33% is a good number, right? But let's look at the valuations, and when you bought those shares, you did that at a valuation multiple of 28.1, and now when you're keen on selling it, the stock is at a P ratio of 16.6. Now you tell me, are you still keen on selling Apollo tires? Of course, there are more factors around this. It's not a simple P ratio game, but this is a very apt example of why understanding valuations is perhaps more important than the percentage price rise, because who knows, you might be selling your winners, which might turn out to be multi-baggers of the future. So do watch out for that. This third strategy might seem a little subjective, but as I read about it, it seemed quite logical and warrants a mention here. So the concept of conviction says that if you have something to sell, sell your low conviction bets ahead of the high conviction ones. What do I mean by that? Or rather, what do I mean by a high conviction bet? Well, these are stocks, mutual funds, or any instrument where you've done a lot of homework. It's a product of your research and analysis, and your investment thesis still holds. On the other hand, a low conviction bet is where you've not put in much effort to understand the business. In other words, you've simply ridden the bull market wave. Or thirdly, and worst of all, these stocks have been acquired on the basis of tips, or perhaps based on what some big name investor or some guy on Twitter is buying. So basically, if you've been lucky with such stocks, then do use this opportunity to sell your low conviction ideas as you look to retain instruments where you have better knowledge and conviction in its business and fundamentals. This fourth strategy is somewhat related to the earlier one, but I've kept it separate for emphasis. And point blank, an all-time high situation is a fantastic opportunity to get rid of the weaker stocks and even the loss-making positions in your portfolio. Now, understandably, we don't buy a stock or invest in a fund assuming that it won't do well, but over time, and I've seen it with my portfolio as well, a typical long-term equity portfolio will have a few fundamentally sound compounders and a decently long tail of dud stocks. But now that those duds, especially in the mid-cap and small-cap space, would have also gone up, after all, a rising tide lifts all boats, do make use of this moment and push out the fundamentally weaker ones or companies that have maximized their earnings, that is, their earnings cycle has started to trend downwards. Now, this might not look like a profit booking strategy, but even if you are booking losses, you are not only shutting down the bad ones, but even the government of India offers a discount. Yes, a discount on taxes. Actually, no. This is even better because the tax loss harvesting rules allow us to set off some of our losses against capital gains, helping us save some taxes in the process. Anyways, the point is, an all-time high situation is a great way to correct your previous mistakes. Many of us invest in equities using the SIP mode, the systematic investment plan. And in addition to it being a convenient way of participating in the markets, it also reduces our timing risk, which is something long-term investors look forward to. Now, just like we are careful with this timing bit when entering the market, it's advisable to use the systematic route during exits as well, especially if you don't have a specific valuation target in mind. This is done via a SWP, a systematic withdrawal plan wherein an investor can sell his or her holdings in a phased manner and in equal lots. But that being said, unlike an SIP where there is no time limit and you can continue investing forever, SWPs require us to define an exit period. Now, since the markets are at an all-time high and a U-shaped correction may or may not happen, ideally your SWP tenure should not be too long, and I think a 6-month tenure is good enough. So for instance, if your equity allocation is at 80 lakhs, so 80% of your portfolio, and you want to bring it down to 65%, then that's a 15 lakh sale. This can be done via a 6-month SWP with 2.5 lakhs moving from your equity fund into your bank account or a different fund of your choice, which is typically a debt or an arbitrage fund. Having said this, you should also be ready to cancel your SWP in case there's a sudden fall in the market, because you don't want to be selling at lower valuations. But the core point is, don't panic and never get rid of all your positions in one go, assuming that this will maximize your profit booking. Another good practice with regards to profit booking is that before you sell any of your stock or mutual fund holdings, always have a redeployment plan. That is, how are you going to apply that money? While this might sound elementary, I'm afraid many investors, including me, are guilty of not knowing what to do with this money after we have redeemed our shares and units. So as suggestions, here are some redeployment avenues that you can utilize. Number one is rebalancing, and I'll be taking this up separately in the next section. Secondly, if you have any financial goals coming up, like paying a down payment for a car or some home renovation that you're planning, then this money can be used there. If you're not into such material things, then a tactical redeployment into a fixed deposit or arbitrage fund or a short-term debt mutual fund is something you should have been prepared for. And finally, there's something you should always have, and that's a wish list of companies that you've always wanted to own. Basically, the money you received from your profit booking can be reinvested into the wish list of companies, of course, assuming that these companies are not excessively valued. The seventh and final strategy for when the equity markets are at an all-time high is to link it to rebalancing. Now, it's a word you might have heard a number of times, and in simple terms, rebalancing is the fine-tuning of your investment portfolio to keep it in line with your original plan. I won't get into specifics here as I've already covered it in earlier videos, but the fact is some investments grow faster than others, like equity in our case, which changes our asset allocation, and rebalancing is one fine way to get it back to normalcy. So essentially, it involves selling equities when the markets are at an all-time high and using that cash to make more investments in non-equity instruments like debt, for example. This ensures you not only do profit booking, but you have now improved the shape of your portfolio and your return expectations are in line with your risk tolerance. If I say it in a more investing-oriented language, then rebalancing makes you divest from relatively overvalued assets like equities, and it gets you to invest that money in undervalued assets. On the face of it, rebalancing might seem illogical to a few because you're technically selling your winners and you're investing it in the losers, but many studies have proven that rebalancing improves a long-term investor's risk-adjusted returns, as markets tend to go up and down, and this averaging technique benefits you in the long term. So use this technique in addition to the other 6 I have shared in this video if you are contemplating exiting the equity markets, but let's do it smartly and in a planned fashion. I sincerely hope you found some parts of this video useful and it helped you organize your thoughts better. Please do consider subscribing to my channel, do like this video, join my newsletter if you haven't done that yet, and I'll see you 3 days from now. Until then.